In 2021 and 2022, crypto venture capital funds raised and deployed over $33 billion, more than the entire prior decade of crypto investment combined. Andreessen Horowitz launched a $4.5 billion crypto fund. Sequoia announced a dedicated crypto fund. Tiger Global deployed hundreds of millions into crypto startups at peak valuations. By 2024, the market had repriced brutally. Crypto VC deal count fell 70%. Valuations contracted by 60 to 80% on many Series A and B deals, and many of the highest profile portfolio companies, FTX, Celsius, BlockFi, Voyager, had declared bankruptcy. But unlike the retail reckoning, sophisticated crypto VC didn't disappear. The institutional players who survived, a 16Z Crypto, Paradigm, Multicoin Capital, had differentiated strategies and structural features that retail-adjacent funds lacked. This video explains what separates institutional crypto VC from the rest. Crypto VC differs from traditional venture capital in three structural ways. First, the primary investment instrument is a token, a liquid, tradable digital asset, rather than equity. This means liquidity events happen continuously on secondary markets, not through IPOs or M&A. It also means token price volatility directly affects fund NAV in real time, unlike the quarterly mark-to-model that equity VC funds use. Second, token vesting and lockup schedules are the primary mechanism for aligning founder and investor incentives. Most VC investors receive tokens subject to 1 to 4 year vesting periods with cliff provisions. Third, governance rights in crypto projects are typically exercised through token voting rather than board seats, which creates fundamentally different influence dynamics between investors and founders. Understanding these structural differences is prerequisite knowledge for any LP considering a crypto VC allocation. The crypto VC data from 2021 to 2026 illustrates the full cycle. Peak deployment in 2022 saw over $33 billion invested globally. By 2024, deal count had fallen 70% to approximately 1,200 total deals, and median deal valuations contracted from $35 million to under $10 million. However, the surviving top-tier funds maintained strong performance. A 16Z Crypto Fund 3, raised in 2022 at $4.5 billion, was reported to be marking key positions at significant multiples despite broad market decline. Paradigm's early-stage positions in DoFi protocols, Uniswap, Optimism, Blur, delivered returns that made the fund's 2021 vintage one of the strongest in institutional crypto VC history. Infrastructure and DoFi protocols outperformed consumer NFT and metaverse investments by a factor of 5 to 10 times across most fund portfolios, validating the thesis that infrastructure bets carry more durable value. Institutional LPs choosing crypto VC exposure must decide between dedicated crypto-native funds and generalist VC funds with crypto exposure. Dedicated crypto funds, a 16Z Crypto, Paradigm, Multicoin, employ teams with deep technical expertise, token economics modeling, and protocol governance experience. They typically have better deal access in top-tier crypto projects and more sophisticated exit strategies around token vesting and secondary liquidity. Generalist funds with crypto exposure, Tiger Global, SoftBank Vision Fund, deployed capital at peak valuations based on momentum rather than deep technical diligence, and suffered disproportionate losses when the market contracted. The structural difference is not fund size. It is domain expertise and the ability to evaluate token economics models that require cryptographic and game theory knowledge not found in traditional VC teams. Crypto VC carries a distinct risk architecture compared to traditional venture. Token price risk is continuous and immediate. Unlike equity marks that update quarterly, token positions reprice daily, creating real-time NAV volatility that can trigger LP redemption pressure even in illiquid funds. Token unlock risk is the second major concern. When vesting periods expire, large volumes of tokens hit secondary markets. If a fund's position represents a significant percentage of token supply, even a disciplined exit can move markets against the seller. Third is regulatory risk. Token securities classification by the SEC creates retroactive legal exposure for funds that participated in token sales that could be deemed unregistered securities offerings, which has already resulted in enforcement actions against several funds. Paradigm's early investment in Uniswap, the largest decentralized exchange by volume, is the canonical institutional crypto VC case study. Paradigm invested in Uniswap's seed round in 2018, pre-product, when the protocol was a theoretical design paper from Hayden Adams. The investment was made on the basis of token economic modeling. The thesis was that a protocol enabling permissionless token trading with automated market maker mechanics would capture a structural fee stream from the growing DoFi ecosystem. When Uniswap's UNI token launched in September 2020 and the protocol scaled to over $1 billion in daily trading volume within months, Paradigm Seed Investment delivered estimated returns exceeding 1,000 times cost basis. The case demonstrated what institutional-grade crypto VC looks like: deep protocol-level diligence, conviction during pre-revenue stages, and patience through multiple market cycles. Institutional LPs evaluating crypto VC funds should apply a four-step diligence framework that differs materially from standard private equity fund evaluation. Step 1 is team assessment. Does the investment team have cryptographic and protocol-level technical expertise, or are they generalist investors applying traditional VC pattern matching to a domain that requires specialized knowledge? Step 2 is token economics diligence. Can the team model token supply dynamics, vesting schedules, and the protocol's fee capture mechanism in detail? Step 3 is vintage and deployment discipline. Did the fund maintain price discipline during peak market conditions, or did it deploy at frothy valuations based on FOMO? Step 4 is exit mechanics review. Does the fund have a structured token liquidation strategy that avoids excessive market impact during vesting unlocks? LP mistakes in crypto VC allocations cluster around three patterns. First, allocating to generalist funds at peak cycle based on brand name. Several of the worst-performing crypto VC positions in 2022 were from household name multi-stage funds that deployed at nosebleed valuations without the domain expertise to evaluate token economics. Second, ignoring fund structure details. Open-end crypto VC structures with quarterly redemption rights create dangerous mismatches between illiquid token positions and LP withdrawal expectations. Third, treating crypto VC allocation as a substitute for liquid crypto exposure. The risk profiles are fundamentally different, and a fund with a 10-year lockup is not a proxy for ETH spot exposure. Crypto venture capital is a legitimate institutional asset class, but it requires domain-specific expertise, structural discipline, and realistic expectations about liquidity and volatility. The lessons from the 2021 to 2026 cycle are direct. Team expertise matters more than brand in this domain. Token economics modeling is a distinct skill set that most traditional VC teams don't have, and vintage selection is as important as manager selection given the extreme cyclicality of the underlying asset class. Crypto venture capital rewards domain expertise and punishes generalist pattern matching. Understanding the structural differences is essential before any LP allocates. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.